You ever wonder where all the money in real estate is starting to go and head towards? And everyone's talking about this idea of the Magnificent Seven. We're talking about Microsoft, Amazon, Meta, Google, everyone else, and this surge of AI. But what if I told you the single most mind-boggling spending spree in human history? It's not about software or social media, it's for bricks and mortar. Well, not exactly bricks and mortar, but I'm talking about the engine for the new economy. And we're going to talk about data centers. Who's powering the data centers? It's NVIDIA. And their shares have hit an all-time high as of late 2025 with $165 billion in revenue. That's a 71% increase year over year. Just absolutely astounding. And you've got the hyperscalers pouring their money in there. I'm talking Amazon, Microsoft, Google, Meta, X with good old Grok. They've poured an estimated $200 billion into AI infrastructure in 2024 alone. And this isn't just a trend. This is one of the largest capital expenditures in human history. And so this is fundamentally reshaping the world of commercial real estate, which means those old office buildings and skyscrapers are on the fast track to becoming ghost towns, and data centers are experiencing the new gold rush. And in this video, we're going to dig in so that you can understand how you can be a part of it, how you can capitalize it, make money along with the Magnificent Seven, the hyperscalers, and NVIDIA. I'm Anton Stetner. I've been here doing real estate in the Seattle Metro for the last 22 years. We do residential, multifamily, commercial, land development stuff. And this one particularly interests me because of all the changes we've started seeing inside of the office space in the last few years since COVID. And so we got to start with the bad news and get the bad news out of the way. The office market, let's be blunt, it is in a state of structural decline. And it is predicted that it could continue to drop even more because right now you're experiencing about a 20% vacancy nationwide. And all commercial real estate is about occupancy. So if 20% of the building is vacant, what do you think happens to the price? The price of that building is going down. And for many property owners that don't have prime real estate, or what we would call A-class real estate, in the best areas with the best tenants, this is essentially an existential threat to their commercial real estate asset. Because most of these buildings were financed on the pro forma, showing that they would basically have full occupancy, that their tenants would be paying a premium, and that it would stay that way for a long period of time. And now those assumptions on the pro forma have essentially crumbled. Real life has hit and the value of those assets are going down. This is creating a tsunami of commercial real estate debt. We've talked about it on other things on the channel. So if you like topics like this, hit that subscribe button, hit the notification button. This is creating a tsunami of commercial real estate with lenders pulling back and an approximate whopping $1 trillion in debt that's going to have to be dealt with in some form or another. So as investors and banks are pulling back from these high-risk office assets, this has created a tsunami that is part of the maturing commercial real estate debt. When everything was cheap during the great financial crisis and rates were at 3, 4, and 5%, everyone locked in their debt. But the problem with commercial debt in general is, generally speaking, every 5 years you have to refinance it. So we have a whopping $1 trillion that's coming due over the next 2 years that's going to have to be dealt with. And these banks can only extend and pretend for so long. And these commercial assets are going to have to be dealt with. But what it's causing is it's causing lenders and investors both to pull back from these high-risk office space assets. We've already established that the office market is just obliterated and that data centers are skyrocketing. But I want you to understand, this is a story of unconstrained demand and growth, and the numbers don't lie. By mid-2025, spending on data center construction has reached about $40 billion, putting it on track to surpass the $44.17 billion spent on offices for the first time in history. In other words, this is the bright, new, shiny diamond of commercial real estate. In 2021, office spending was over $65 billion and data center was spending less than $10 billion at that time. This is total flip and reversal of those roles. So ask yourself, what's driving this? Well, it's AI, it's cloud computing, it's our cell phones, it's ChatGPT, It's the work from home movement. Generative AI alone is projected to consume 4.5 times more power by 2023 than it does today. So these are power hungry beasts. So this isn't about just capital being redeployed from one sector to another. This is about a strategic reallocation of funds. In 2024 alone, global data center investment surpassed $60 billion. And 40% of that came from non-traditional investors like private equity and sovereign wealth funds. So what they're doing is they're pulling back from these distressed assets. They're getting out of office. They're probably getting out of multifamily, and they're looking for things with literally zero vacancy, long-term leases, and tenants that have some of the best credit in the world. And I'm talking the credit-worthy companies of the Mag 7 like AWS, Google, and Microsoft. But what makes these assets so resilient, and how is it possible to finance them when the rest of commercial real estate is really in a debt crisis right now? Let's break down the magic behind the financing. The struggling paradox here in the commercial debt market and the booming data center market is actually pretty easy to solve if you understand one thing. Not all lenders are created equal, and they are enthusiastically deploying capital for data center projects because of their predictable cash flow, their high-quality tenants, and their long-term leases, while at the same time pulling away from less predictable cash flow assets such as office. Because at the end of the day, this all comes down to the tenants and the leases. Data center tenants are typically AAA rated tenants with a 10 to a 15-year lease. And this provides what everyone wants in commercial real estate: stable, predictable, consistent income with dramatically lower risk. This isn't traditional real estate. This is essentially digital infrastructure. And the value is less tied to the physical building and its location and more to the high quality tenant and cash flow that is coming off of that performing asset. This fundamental difference makes them the perfect fit for commercial mortgage-backed securities, or CMBSs. And in the first quarter of 2025, we saw a record-setting $4.5 billion issued in commercial mortgage-backed securities for data centers. This isn't an accident. The lenders are monetizing these predictable income streams, chopping them up into blocks and selling them off as commercial mortgage-backed securities, which is allowing these operators to finance these new multi-billion-dollar facilities without over-leveraging their own balance sheets. But with every good story and the pot of gold that is hidden at the end of the rainbow, it's never all sunshine and fiber optic cables. What we have here is we have a major bottleneck that's going to separate the winners from the losers. And it's not what you think in this part of the market. The number one threat to the whole data center sector isn't a lack of capital. What it really is it's a shortage of power and a possible supply crisis in the supply chain. In other words, being able to get those precious NVIDIA chips and GPUs. This puts the US power grid under massive, immense pressure from this explosive AI demand. These data centers are sucking down the amount of power it takes to power whole cities. And as a result, there are critical electrical components that are facing supply crisis, like transformers and generators, causing some of these project timelines to be delayed or extended for years. The old mantra of location, location, location is essentially being rewritten to where is the freaking power? How do I get my proximity to power? How do I get that power fast, quick, and cheap? And it's why developers and land bankers and some speculators are banking on rural land with cheap, abundant power. There's your golden nugget. So for example, what you've been seeing here in Washington State is up and down the Columbia River, where we have all kinds of power. You are seeing data centers be built over and over and over again. And the thing to understand is there's always an opportunity inside of a crisis. And this crisis is a catalyst for innovation. Data center operators aren't just thinking about power. They're thinking about becoming these companies themselves. They're pivoting towards advanced energy solutions, solar, battery storage, gas, and even on-site generation. And this is also going to push the small nuclear reactor that I personally would like to see a lot more of. For investors, this is putting another element of critical due diligence that you have to pay attention to. You must look for developers or rural land or areas that have the most robust energy strategy and structure already in place. And you have to secure purchase agreements for them. That will be your competitive moat. You're going to use things like options and earnest money to be able to control these types of property. So now that we know the market, we know the money, we know the major challenges, what's the most profitable way for an everyday investor to get in on this type of action? The problem for the everyday investor is, let's be honest, this is a very expensive game. That's why we got private equity and hedge funds crawling all over it. And there's a high cost and a high complexity of direct ownership, making this inaccessible for a lot of the smaller investors. So my recommendation would be looking for syndications, looking for REITs that participate in this area. You need to look for publicly traded companies that are going to offer a rare opportunity of exposure to this fast-growing segment and dividends and cash flow. These publicly traded companies, such as REITs, are going to offer exposure to this super fast growing sector in technology and in commercial real estate with attractive dividends along the way. So the path forward is clear. We need to embrace this divergence and acknowledge that the office market is not what it used to be. And office in a lot of areas is going to get redeveloped. That's its own opportunity. And that data centers are on a fundamentally completely different trajectory than the rest of commercial real estate today. Focus on tenant quality, focus on long-term leases, focus on proximity to power, focus on maybe being the actual power company itself, and look beyond the building and the property. You're looking for operators with a clear strategic vision who are about securing clean, reliable, consistent energy. That is a new critical element of your due diligence in this form of commercial real estate. And this one isn't just about real estate. This is about the very infrastructure that is powering the future, and how you now have some insights for yourself on how to win along with the Magnificent Seven. If you found this useful, hit that magic subscribe button, share it with a friend, or drop any questions or comments that you guys have below. And thanks for watching and hanging out with us.